The inflation report could impact the
pricing
Fed
power
and
and
the
pricing
market.
sensitivity.
Consumer prices in January were up.
Core PCE inflation number, which again the Fed is watching closely.
For the average person, inflation simply means higher prices and a lower standard of living. In other words, it's bad news. But would it shock you to know that sophisticated investors use inflation to build empires and multiply their wealth? Would you be even more surprised to learn that governments use it as a license to print money, avoid paying debts and collect more taxes? Some say that the rich are getting richer and the poor are getting poorer, and inflation might just be to blame for that. In this video we're going to look at how all of this happens, but more importantly, we're going to talk about how you and me can use this to our advantage to grow our wealth. In simple terms, inflation shows us how much the cost of goods and services increased over a period of time. There are a number of factors that can cause inflation, like global events, underproduction, low interest rates, and so on. But here's a simple example. When the economy is strong, people start earning more. When they earn more, they start spending more. And when there's not enough product for sale to keep up with the demand, prices go up, causing inflation. Now there's an important number that you need to keep in mind, and that's 2%. Governments want an average inflation of about 2%, which means they want things to become 2% more expensive on average every year. Now whether they hit this target or not, that's up for debate. And that encourages the economy to keep on growing at a steady rate. If inflation is higher or lower, they will implement different monetary policies with the help of central banks to get it closer to the 2% target, like raising or lowering interest rates. And it's important to know that central banks, such as the Federal Reserve or the Bank of England, are independent of the government, but they do work hand in hand for the benefit of the economy. But why does inflation exist in the first place? Well, apart from the insignificantly small fact that an increase in costs will naturally mean an increase in tax revenues for governments, the alternative to inflation is much worse. Think about it. If instead of prices going up 2% every year, they would reduce every year, you, my friend, would stop buying stuff, because you could get it cheaper if you just waited. The companies that sell you those products would make less money, and they would fire some workers to save costs. Unemployment would go up, people wouldn't be able to afford to buy anything, and the economy would collapse. Sounds dramatic? Back in August of 1929, the US experienced the devastating effects of deflation in an event known today as the Great Depression. After experiencing a time of economic growth coming out of the First World War, Americans were living the good life. Consumer spending was at an all-time high, with large amounts of money being spent on fashion, home appliances, radios, and the stock market. Banks wanted to cash in on the action and were offering credit at cheap rates for pretty much anything you wanted to buy. But some industries such as farming, car manufacturing, and construction started to slow down. The stock market collapsed and banks were going under. Interest rates were on the rise and a lot of businesses were going bankrupt due to an increase in the cost of the loans they took. People were made redundant, and so a great deflationary period started and lasted for just over 10 years. And although it started in the US, it rippled throughout the world, bringing the global economy to a halt. So yeah, governments don't really want to risk going back to that. Inflation, on the other hand, when contained to lower levels like 2% a year, helps stimulate production, encourages spending and wage growth, and more importantly, it prevents deflation. But whilst all of these benefits are needed for a healthy economy, there are additional, lesser-known benefits which can be leveraged to create wealth. But to understand these, we first need to understand the relationship between inflation, assets, and debt. So I'm going to try and simplify it. The majority of people know they should be investing, but they don't know why that's the case. The government decided that your money will lose 2% of its value every year, so now you're left with two choices. Wait until your money is worthless, or exchange it for something that won't lose its value, or even better, increase in value. What would you do? Most of the things people buy in their lives fall under one of two categories: assets and liabilities. In short, liabilities are non-essential things that you buy that will be worth less or cost you money as time goes on. Assets, on the other hand, are things that you buy that will make you money or be worth more in the future. Financially successful people try to avoid buying liabilities, saving money instead and investing it into assets. And they do this because assets do a lot better throughout the years compared to cash, especially in the long term. Trading your money for shares in the S&P 500, for example, will give you an average return of 10% a year. And even if inflation reduces that value by the magic number, you're still 8% up compared to being 2% down if you held your money in cash. So if you want inflation to work in your favor, exchange your cash for assets that go up in value when there's an increase in costs. But what if instead of saving money to buy assets, you borrowed it? Think about it. You could get the money you need a lot faster. You also don't pay taxes on money borrowed or debt. But wait, there's more. When you have money, inflation devalues it every year. But what most people don't know is that when you have debt, inflation also devalues it every year. Inflation eats away at your debt at the same rate it does with your savings, causing a shift of value from the lender to the borrower. Now obviously, eroding your debt by 2% a year means nothing if your interest on the debt is substantially higher, so make sure the maths add up. Governments also go into debt borrowing money to keep the economy afloat without worrying about paying it back, because they can just wait for inflation to devalue their debt. But here's another example. Elon Musk could have sold billions of dollars of Tesla shares to buy Twitter, but he would have paid capital gains tax on the sale. Instead, he borrowed the money and used the shares as a guarantee for the loan, which meant he got the cash tax-free and also kept ownership of his shares. He most likely got a cheap rate on the loan because of the perceived value of Tesla, and he knew that inflation would devalue his debts throughout the years while Twitter grew. And 2% might not sound like a lot to shave off your debts every year, but in Elon's case, 2% of $25.5 billion meant that he eroded his debt at a rate of $510 million a year. And inflation also peaked at 9.1% in 2022 in the US, so we probably saved a few more pennies there. So the question is, how do we benefit from the same economic advantages on a smaller scale, especially when new to investing? Buying safe assets and waiting for inflation to do its thing is a good start, but if you can use debt to buy assets in a safe way, that will compound a lot quicker. I started off with a house. Investing in property using a mortgage allows you to buy a very expensive asset without forking its value in cash. Although the bank could take your house if you don't pay, you still own the entire house despite the loan, just like Elon did with his Tesla shares. Inflation will still push the value of your house up and will erode your debt every year. And yes, you'll have to pay interest on this loan, but chances are you spend that money on rent anyways. If you rent out the house to other people, your tenants will pay the interest on the loan instead. A few years down the line, you can take a bigger loan against your house to buy more assets or houses or start a business. But at the very least, you will have a very expensive asset to pass on to your kids a few years down the line. And just to put things in perspective, the average house price in the UK 20 years ago was about £150,000. Fast forward to 2023 and the average house price almost doubled at £288,000. If you bought that house for £150,000 back in 2024, your debt devalued with inflation every year since, and the £150,000 borrowed in 2004, it's only worth about £75,000 in real value today, so you will pay back less money in real terms. Essentially, you halved what you owe just by waiting. And that, my friend, is the power of inflation. If you like this video and you want to learn more about investing, check out this video here, where I attempt to explain why investing doesn't work. Controversial?